Right, let's just go over the market. Top row is crude, and the bottom row is ES. All right, on the left we have higher brick sizes. On the left column we have higher brick sizes. On the middle column we have lower brick sizes. And on the right hand side you have the wave chart. So as you know, Wyckoff, the way he did day trading, he basically used the wave chart and the tape reading chart together. All right, together. That's the thing. That's how he did it. Anyway, let's go and take a look at the end of day trades that were fairly easy to get. Right. So the first thing is on the ES, on that higher brick size, right here. You see that this is a level because of those white boxes. So that just means there's heavy selling pressure from there. And market's retesting. So it's retesting that white line, that 44, I don't know, is that 44.70-ish? It goes and it sells. All right, let me get rid of some of the lines here. So it basically did this and it did this. So immediately I know it's a change of behavior. Why? There's so much selling in that area and now it's still there. Okay, it's still there. So it goes into that area. From that area, the selling is there. So this is what happens. You find the level, right, where there was selling, and then it goes to that area and the selling is still there. And that's it. So look at this, 83,000 contracts on the wave chart. This has the biggest volume, a lot of volume. And also the market is fairly liquid at this time. Okay, so what you know is, the selling pressure came in. It goes back and it tests the high. All right, so what are some of the errors? Okay, you have to know where to take a short. And you have to know where to put the stop. The stop must go above here, either here or a little beyond, whatever your style is. If you put it right here, there is a chance of an upthrust, and on the inverse side, it would be a chance of a spring if it was a bullish change in behavior. This is a bearish change of behavior. If you put your stop right here, there is a chance that it's going to get taken. But there's a lot of other factors to consider. Over here, if your stop isn't over here and it's over here, for example, at this high, that high got taken right here. So that's the problem. If you don't know where to put the stop, for example, there's a wick right here, if you can see it, on the red bar. That's where the stop goes. If it went to the next highest bar, which is here, on this doji looking bar, that's the exact level it tested. So that's not a coincidence. It is because folks thought, okay, it's breaking down, let me start cutting risk, and they put their stops here. And that's exactly where it got taken. Anyway, long story short, there's a level and there's a change of behavior. Now, time to get in on the retest. Market pulls back. A second mistake would be in my opinion, it's entry on the dojis. These dojis are not red bars, they're not reversal bars, right? This is a red reversal bar where the close takes out the low of the prior bar. So that's the quote-unquote trigger. The selling pressure is in. Dojis, they're not breaking the lows, and they're not closing below the lows, and they're not red or green, so it's not good enough. Here you have the clear reversal at the test, and bang, it goes down. As it goes down, even if you don't get in, like right away, it gives you a test here. It gives you this test. Okay? So that's the other thing to notice. Markets have a tendency to test and retest and test some more. the same levels. So you have to know where to put your initial stop. You have to know how to enter. If you miss the entry, meaning the market makes a wave lower, it has a tendency to come back, tap the low, and then go. Bingo. So what are the quote-unquote lessons over here? The lesson is level plus change of behavior. Level plus change of behavior. Not change of behavior by itself. A level plus change of behavior. Second is the red bar reversal. Waiting for a red bar reversal. And third is the where to put the initial stop. Okay, so the level plus change of behavior, waiting for the red bar reversal. If you don't get it, just wait for a retest. ES has a very strong probability of retesting. And third is where to put the initial stop, and then moving the stop accordingly. Okay. Now the tapering chart did show us something. Here, if you see 95, 36, 33, 51, right there is your effort. Again, 33, 51. Why is it effort? This has 4 X's and cumulative volume is 33,000. This has 3 X's, which is 1 less X than the prior rally attempt, and has more than 50%, total of over 150% plus of the volume of the prior bar. The reason is effort. Effort to go up. And you confirm that after this reversal break here, which was the change of behavior. After that, it starts moving sideways and making the base. Very important for it to make the base. Why? Because that's the follow-up distribution. Here is the distributive action within here. Then you have the pull down and the test. So it's going to go down. And also note, this is also effort. Why? This is 3 boxes, 23. There's only 2 boxes in 44. Almost double the volume, but no reward right here. 23, here, 44. 3 boxes should have more volume than 2 boxes, but the 2 boxes have more volume than the 3 boxes, meaning there's effort and no reward, and after, which is confirmed by the lower low. Anyway, so after that, market goes down. Even here, you can, I'll show you right here. Here you have 48, here you have 68, here you have 81. There's 1, 2, 3, 4, 1, 2, 3, 4. You'll see there's some indication of effort, meaning the same amount of boxes, but more volume here than the prior volume. So, or you can even see it in the wave chart. Here's 71,000, here's 72,000, but the distance is less. Right? You just have to kind of pick this up. And also, like over here, when you have 25 and 48, this effort is not the effort of bag holding. This effort here is the effort of absorption, specifically supply absorbing demand. Right here, the effort here is supply absorbing demand in order to break it. So there's effort, meaning high volume at these levels, because you see this is a support level, right? From this low, it's a support level. So supply is absorbing that demand at the support in order to break it. Okay, I'm done with the ES. Let's go to crude. In crude, what do you see? You had a base here, beautiful. Here, right? See the base, it's I don't know how visible it is, but you had that come down, break out here. You have 1, 2, 3, 4, 5 count, and 6 count. 97 volume, which is bigger than 1, 2, 3, 4, 5, 6, 7, plus 5 bars, and that initiated the move. Here there's a lot of, I don't know what the hell is going on over here, but the market basically pulled back to test. It hinged over here, and then it went up, and it started building volume. So what's the issue here is that it is building volume and then breaking. So to me, it was obvious that, over here is distributive action, and this is the break on 12,000 contracts here. Not 12,000, what was it? I forgot what it was. Oh yeah, 12,000 contracts here. And then just pulling back on only 2,000 and 6,000. Testing here, and then just giving not a big move, but end of day, end of week. So what are the lessons here is basically you have a lot of volume and you had a break, right? So this volume here is distributive. Why? Because volume should not be distributive. Volume is at, let's say the market goes up, you have a lot of volume, and the price goes down. So obviously the volume that's up is distributive. And this is a concept also known in the Wyckoff course when he talks about the New York Times study. You can go check it, section 7 something. This is the first study. And just take a look at the turning point of the bullish New York Times study becoming bearish. And you'll see at the highs he mentions hypodermic maneuver, and then on it there's the top bar, it has so much volume, and then like 1 or 2 days later it gets taken out. So similarly, you have a lot of volume, and then it gets taken out by this big wave and offering the test. Anyway, so that's all I wanted to cover. Have a good day. Have a good weekend. Bye.